Gold and silver are not easing lower, they're collapsing. This isn't a pullback or a pause, it's a straight down move happening in real time. As I'm recording this, gold has already sliced through 4,600, silver is sitting around 72. Every refresh makes it worse, 45.50, 45.20, and counting. There's no stabilization, no bounce. This is no longer a correction. This is a live market crash unfolding while you're watching. Friday was supposed to be the bloodbath that cleared everything out. Silver was down 38%. Gold dropped 16%. The worst single-day move in more than 4 decades. Most people assumed that kind of damage meant the selling was finished. They thought the weak hands were gone. They thought the bottom was in. That assumption was wrong. What you're seeing now is forced liquidation, margin calls firing back to back, positions being closed not by choice but by obligation. Traders aren't deciding to sell, they're being sold out, one account at a time, one position after another. And instead of slowing down, the pressure is accelerating. My name is Michael, and welcome to The Quiet Invest. If you're new here, this channel focuses on what's actually happening underneath the market headlines, especially when panic and misinformation are everywhere. Subscribe now, because this kind of breakdown is exactly what most people miss until it's too late. And if this analysis helps you, hit the like button. It pushes this video to people who need to understand what's going on before they get caught on the wrong side of it. In my previous video, I walked through the exact level, 117, where silver was set up to fail. At the time, people were saying, it's going higher, 118, 120, no problem. That optimism didn't survive contact with reality. Now here's what changed this morning when markets opened. Thousands of traders tried to dump their silver ETF positions. They couldn't. Orders were rejected. Circuit limits were hit. Friday's collapse was so extreme that today's prices are still below the exchange's allowed trading thresholds. The system simply isn't accepting sell orders. That means anyone who held through the weekend expecting to exit on Monday is now stuck, completely trapped. They can't sell at any price, not because there's no buyer, but because the exchange won't allow it. This is happening right now as gold breaks below 4,500 and silver crashes through 72. In this video, I'm going to explain exactly why this happened and, more importantly, how to make sure you're not the one getting caught in it. Here's the trigger. The mechanism behind this move is something called a margin hike. When you trade futures, you don't put up the full value of the asset. You post a fraction, usually around 10%. Control $100,000 worth of silver, and you put down roughly $10,000. That's your margin. That's your collateral. But if the exchange raises margin requirements overnight, everything changes instantly. You're required to post more cash immediately, not tomorrow, not after your bank transfer clears, right now. If you don't have that cash sitting there, your position is automatically liquidated at whatever price exists in that moment. And when thousands of traders are forced out at the same time, that moment produces the worst possible prices, straight into the floor. No discretion, no mercy. One margin hike can be absorbed.
Most traders don't run fully exposed. They keep a cash cushion for exactly this kind of event. A margin hike hits, they wire in more funds, they survive. That works once, maybe twice. But what happens when the hikes don't stop? What happens when it's not 2 margin increases or 3, but 8? 8 margin hikes in 8 weeks isn't pressure, it's eradication. And that's exactly what happened. The CME didn't just raise margins once and walk away. They executed 8 increases over an 8-week span, each one carefully timed to pull more liquidity out of long positions. December and January were relentless. A hike just before Christmas, another over New Year's weekend. Every time traders thought the worst had passed, another demand for cash landed on their accounts. Then came the move that changed everything. On January 13th, the CME switched silver to percentage-based margins. That means margin requirements now rise automatically as price rises. You don't add leverage, you don't change your position. Silver goes up, and your required cash increases anyway. It's a self-tightening noose. The higher the price, the more collateral you're forced to post just to stand still. And it didn't end with Friday's collapse. Monday morning brought another hike, then yet another one later in the week. 8 total. For perspective, this isn't normal by any historical standard. In all of 2024, there were 2 margin hikes. In 2023, 3. In 2022, 2. 7 hikes over 3 full years was considered aggressive. 8 hikes in 8 weeks has never happened. I checked 2 decades of CME data. There's no precedent for this. Each hike forces selling. Forced selling pushes prices down. Falling prices trigger margin calls on traders who weren't even impacted by the original hike. That leads to more liquidations, more selling, lower prices, and more margin calls. It's a cascading loop, a death spiral, engineered, not accidental. That spiral is what you're watching right now. Gold breaking below 4,500, silver slicing through 72 with no floor in sight. But here's the detail that didn't let me sleep last night. On the same day the CME raised margins again, the Shanghai Gold Exchange did the exact same thing, raising margins from 20% to 26%. Same day, same direction, same response. Chicago and Shanghai, 14 time zones apart. Think about how strange that is. The US and China don't coordinate on trade, sanctions, technology, or geopolitics. They clash constantly. But suddenly, when it comes to silver margins, they're moving in perfect sync. That doesn't happen unless both sides are afraid of the same problem. And that problem is the paper-to-physical ratio. On COMEX, the ratio is roughly 356 to 1. For every single ounce of real silver in a vault, there are 356 paper claims tied to it. That system functions only as long as traders are willing to settle in cash. The moment people start asking for physical delivery, the math breaks, and people are asking for delivery. In the 3rd week of January alone, 33 million ounces of silver were physically removed from COMEX vaults, not traded, not transferred on paper, loaded onto trucks and gone. That was 26% of total inventory, gone in a single week. 4 years ago, COMEX held around 430 million ounces. Today, that number is closer to 113 million. Nearly 3/4 of the metal has disappeared, and the pace is accelerating. Early January saw about 7 million ounces leave. By the 3rd week, that jumped to 33 million. This isn't retail demand. Retail investors don't move silver by the truckload. 33 million ounces requires logistics, security, storage. This is institutional activity. Manufacturers, sovereign funds, industrial users, smart money pulling metal out before it's no longer available. And they're doing it before March. March matters because March futures represent roughly 528 million ounces of promised silver delivery. Let that sink in. 528 million ounces promised, about 113 million ounces available. That's nearly 5 times more silver promised than physically exists in the entire COMEX system. First notice day is March 27th. That's when every trader holding a March contract must choose cash settlement or physical delivery. If just 22% of contract holders demand metal, the vault is completely drained. Not strained, not tight, empty. So what happens when the 23% shows up asking for their silver? That's the scenario both the CME and Shanghai are desperately trying to prevent. This is why you're seeing coordinated margin hikes across exchanges. The goal isn't stability, it's attrition. They need long positions gone before delivery requests expose how fragile the system really is. And it's working. Look at the prices right now. Gold around 4,500, silver near 72. Longs aren't exiting, they're being erased. But here's the key detail that proves this isn't a genuine market collapse, this is engineered. Pull up 2 prices side by side. First, COMEX silver, the paper price, the number you see on financial TV, roughly $72 and still falling. Now pull up Shanghai silver, the real market where real metal actually changes hands, around $100. Same metal, same day, same global market. A $28 difference. That gap isn't normal, it isn't noise, it's a warning sign.
Paper silver in New York is priced at $72. Physical silver in Shanghai is priced at $100. That's nearly a 40% premium for real metal. Ask yourself a simple question. If silver were truly worth $72, why would anyone, especially industrial buyers and manufacturers, pay $100? They wouldn't, not unless they knew the paper price was fiction. They know the $72 price is artificial. They know it's being forced lower, and they're pricing silver based on what it's actually worth to them, closer to $100. Here's what makes this even more revealing. The gap isn't closing. On Friday, the spread was about $25. By Monday, it widened to nearly $30. Today, even as COMEX prices fall harder, the gap is still sitting around $28. Shanghai isn't collapsing alongside New York. Physical silver is holding its ground, while paper silver is in free fall. That tells you everything you need to know. If this were a real crash driven by supply and demand, both markets would move together. Paper and physical would fall in sync. They aren't. One is collapsing, the other is stable. That means one price reflects reality, and the other is being pushed. Only one of those prices is honest. Now ask the next obvious question. Who benefits from that distortion? JP Morgan holds the largest short position ever recorded by a bank. They've been short silver for over a decade. Every dollar silver drops translates into massive profits. Bank of America holds significant short exposure. HSBC as well. These institutions sit on exchange committees. They see positioning data. They understand exactly where forced liquidations will occur. When retail traders lost 38% on Friday, these banks made billions. As gold breaks through 4,500 and silver crashes below 72, they're making billions more. I'm not accusing anyone of illegal activity. Short selling is legal. Exchange committees are legal. I'm simply pointing out that the entities profiting the most from this collapse are also the ones with the most influence over exchange rules and margin policy. You can connect those dots yourself. Timing matters too. Late Thursday evening, Reuters published a story claiming the U.S. government was ending support for strategic metals. The sources were anonymous. Algorithms reacted instantly. Selling cascades triggered across metals markets. 3 hours later, the Department of Energy issued a statement. The report was false. Their words, misinformed or deliberately misleading, completely incorrect. But it didn't matter. The damage was already done. Algorithms don't reverse because of corrections. Once the sell-off is triggered, it feeds on itself. That same night, news leaked about a hawkish Federal Reserve Chair nomination. Bad optics for metals. The official announcement came Friday morning after the damage was locked in. None of this happened in isolation. The margin hikes, the headlines, the timing, the forced selling, together they tell a very clear story. This wasn't a natural crash, it was a manufactured one. Insiders knew on Thursday night. Fake headlines, leaked nominations, 8 margin hikes stacked into the same window, all of it lining up perfectly. You can call that coincidence if you want, but here's something almost no one is talking about. The day before the crash, there was abnormal options activity in silver ETFs, massive put buying. Someone placed very large bets that silver was about to collapse before it happened. Either that trader was unbelievably lucky, or they knew what was coming. Now look at what happened to people who tried to get out once the selling started. In China, the UBS SDIC Silver Fund was completely halted, not slowed, not limited, fully frozen, an entire trading session with 0 executions, no buying, no selling, nothing. Imagine watching silver drop 30% and being unable to do anything. Clicking sell, refreshing, still nothing.
calling support, hold music, watching your account bleed minute by minute while the exit door stays locked. That's exactly what thousands of Chinese investors experienced. In the US, the damage was just as brutal. ProShares Ultra Silver collapsed 62% in a single session. If you went to bed Thursday night with $100,000, you woke up Friday evening with $38,000. Gone. One day. The iShares Silver Trust dropped 31%, the worst day in its entire history. But the price drop wasn't even the worst part. Traders tried to sell and couldn't. Orders rejected, systems overloaded, customer service lines backed up with wait times stretching past 2 hours, and when people finally got through, they were told there was nothing that could be done. One trader contacted me saying he attempted to close his futures position for 18 straight hours, every order rejected, watching his account drain dollar by dollar, then thousands at a time, with zero ability to stop it. As of last night, some traders were still locked out, days later, unable to access balances, unable to trade, still frozen. Look at the sequence carefully. The price crashes, the exits get blocked, margins are raised again. Crash, lock, raise. If you were designing a system to wipe out long positions and transfer wealth from retail traders to institutional shorts, this is exactly how you would build it. Now, here's what makes this even more revealing. None of this aligns with fundamentals, not even remotely. Silver has been in a supply deficit for 5 straight years. Solar panels need it, EVs need it, AI chips need it, smartphones need it. Demand keeps rising while mine supply stays flat. Since 2019, the cumulative shortfall is roughly 1.3 billion ounces, about 18 months of global production already consumed. Then China shut the door. As of January 1, 2026, silver was added to China's strategic materials list. Export licenses are now required. Export volumes are already down roughly 40%. China refines about 65% of the world's silver. They just told the rest of the world to find another supplier. There isn't one. And this isn't just hurting traders. Real businesses are being destroyed. In India, in the silver jewelry hub of Rajkot, 44 firms have declared bankruptcy in the past week. Over $400 million in losses. Families who've worked in the silver trade for generations, gone. In London, 2 hedge funds have suspended redemptions. They can't return investor capital because their silver positions are underwater and they can't exit.
In Dubai, physical silver premiums have surged to 15% over spot. Dealers can't source enough metal to meet demand. This crash is creating damage across the global financial system, and it's only been a few days. Now, connect the dots. A 5-year supply deficit, exploding industrial demand, China restricting exports, and prices collapsing. That only makes sense if paper prices are being driven down ahead of March delivery. I believe physical ultimately wins. It always does. Paper claims can be created endlessly. Metal cannot. But right now, paper is winning the short-term battle. Gold around 4,500, silver near 72, long positions getting wiped out. So what happens next? Where does this end? Nobody can tell you exactly where the bottom is. Anyone claiming certainty is lying to you. In a forced liquidation environment like this, price targets don't mean anything. Key support levels, the ones that are supposed to slow things down, are shattering instantly. There's no respect for technicals right now, but obsessing over price levels misses the point. In crashes like this, price is the least useful signal. What matters is behavior, and that's where this story isn't finished. The Shanghai premium is not collapsing with paper. Physical buyers are still paying close to $100, while paper silver trades around $72. If this were a genuine, fundamentals-driven crash, physical prices would be falling right alongside paper. They aren't. Physical is holding firm. That tells you exactly which market reflects reality and which one doesn't.
Lease rates are another warning sign. They're sitting between 8 and 10%. Normal is around 0.5%. That's not a small spike. That's 20 times normal levels. Institutions are desperate for physical metal. You don't pay 10% to borrow something you believe will be cheaper tomorrow. You pay that because you need it now and can't source it anywhere else. Vaults are still being drained. Smart money continues to take physical delivery. 33 million ounces left last week alone, and this week could be even larger. While retail traders panic and liquidate paper positions, institutions are literally backing up trucks and pulling metal out of the system. March open interest is another critical signal. Despite the crash, despite 8 margin hikes, despite forced liquidations, open interest remains elevated. Traders are still holding March contracts. They still want delivery. They haven't walked away. And here's the key point. Nothing fundamental has changed. The supply deficit is still real. The shortage is still real. China is still restricting exports. Industrial demand is still growing every single day. The only thing that has changed is the paper price, driven lower by margin hikes and cascading forced selling. Eventually, paper has to reconcile with physical. It always does. History is unambiguous on this point. Physical reality wins every time. The real question isn't if, it's how much damage happens first, how many traders get wiped out before the break, how far paper is pushed down before the system snaps. I believe physical wins. It always has. Paper claims can be created endlessly. Metal cannot. That truth is held for over 5,000 years. But here's what panicking retail traders often miss. Crashes don't destroy wealth, they transfer it. On Friday, wealth moved from retail traders to banks. When this reverses, it moves back. The only question is which side you're on when that happens. Paper at 72, physical at 100. That gap closes eventually, and someone profits when it does. So here's what I'm watching. These are the indicators that actually matter. First, the Shanghai premium, currently around $28. This is the truth meter. It measures the gap between what paper markets claim silver is worth and what physical buyers are actually paying. If that gap widens toward $40, paper pricing loses all credibility. If it narrows because physical collapses, then the manipulation thesis weakens. But if it narrows because paper rises to meet physical, that's when the regime changes. Second, COMEX vault levels. Every Friday, the data comes out. Last week, 33 million ounces left. If another 20 or 30 million leaves this week, inventories will be critically low well before March. Ask yourself, who is taking this metal? Where is it going? Why are institutions paying for logistics, security, and storage while prices are supposedly crashing? They know something. Third, lease rates. Currently 8 to 10% versus a historical norm of 0.5%. That's not a small spike, that's 20 times normal levels. Institutions are desperate for physical metal. You don't pay 10% to borrow something you believe will be cheaper tomorrow. You pay that because you need it now and can't source it anywhere else. So here's the last critical question. How many March contracts are still open? If traders are giving up, closing positions, and walking away, open interest falls. If they're holding on despite the damage, open interest stays elevated. High open interest heading into first notice day means delivery pressure. That's exactly what the exchanges are trying to prevent. Now watch the stress signals. Trading halts, platform freezes, account lockouts. If more funds are halted, if more platforms freeze, if more traders report being unable to access accounts or execute trades, that tells you everything you need to know. Healthy markets don't freeze. Systems only lock up when they're under extreme strain. Shanghai premium, vault levels, lease rates, March open interest, system stress. Track these, not headlines, not price targets. The data tells the story long before the narrative catches up. A widening Shanghai premium means paper pricing is losing credibility. Spiking lease rates means institutions can't source metal. Platforms freezing mean the system itself is cracking.
These aren't abstract statistics, they're warning lights. Now understand this clearly. What you're watching is not random. This isn't normal market behavior. This isn't simple profit-taking after a rally. 8 margin hikes in 8 weeks, unprecedented coordination between CME and Shanghai on the same day, entities that usually oppose each other suddenly moving together, unusual options activity the day before the crash, a persistent $28 gap between paper and physical prices, something that shouldn't exist in an efficient market, vault inventories draining at catastrophic speed, smart money rushing for physical metal, traders locked out of accounts, unable to exit, 44 firms bankrupt in India, hedge funds freezing redemptions, physical premiums spiking globally. This is not a correction. This is a coordinated assault on long positions designed to force them out before March delivery exposes the fractional nature of the system.
And it's working. Longs are being wiped out right now. Gold around 4,500, silver near 72. But the fundamentals haven't changed. The shortage is still real. The deficit is still real. Physical silver is still trading near 100, while paper trades at 72. At some point, this ends. Paper reconciles with physical. It always does. The real question is whether you survive until that moment. Can you hold through the pain? Did your stops get triggered? Did margin calls force you out? One trader messaged me Sunday night. He understood everything correctly, and he still got destroyed. Being right isn't enough if your position can't survive. Ask yourself honestly, do I understand my exposure? Do I have a real exit plan? Is my position sized for survival? Or am I one margin call away from losing everything? The winners in markets like this aren't the ones who predict perfectly. They're the ones who manage risk, stay calm, and remain solvent while others panic. Survive first, act later. This isn't financial advice. Your money, your responsibility. But if you're watching gold break through 4,500 and silver collapse through 72, you need to understand what you're actually seeing. You need the full picture, the margin hikes, the coordination, the divergence between paper and physical, the vault drain. That's what this video gave you. Gold at 4,500, silver at 72, Shanghai at 100. That gap is screaming. Paper and physical cannot stay this far apart forever. When it closes, someone will have bought at the bottom. Someone will have held through the pain. Someone will have seen what others missed. That could be you. Or you could be the trader who messaged me Sunday night. The difference isn't luck, it's risk management. Drop your thoughts on this crash in the comments, share this with someone who needs to see it, and subscribe to Quiet Invest.